right. What's going on here now? It's not letting me resume my share now.
We can still see your screen. You might want to just stop sharing and then start again.
Nope. You guys can see.
Right now, we just see you.
Okay.
Oh, there we go. We can see your presentation.
Okay, cool. Perfect. All right. Well, welcome everyone. And my name is Annabelle, and this is a weekly call, how to get your first multifamily investment deal. Just a little information about myself. I am a real estate broker. I've been in business for 24 years and part of a global real estate company, eXp Realty. And the purpose for this weekly call is really just to share with everyone that's on the call the steps that I took in purchasing my first multifamily deal. Many times also I bring in guest speakers from the multifamily space to just share with us, and so that we're able to expand on our knowledge and really go out and do this for ourselves. I mean, I know that at the beginning, it's just, it's always scary, right? You don't know what direction to go. And really this platform is to just start, discovering and start looking at just different things that we can possibly do to just strengthen, put more knowledge inside of us. I encourage everyone to just participate, ask questions. Everyone's at different levels in this business, and it doesn't matter if you've never invested and you're just starting to invest and you have questions, and maybe you're a little bit more experienced and you've done it already. Share. This is just a platform where it's to be used to share with everyone. I'm not selling anything or offering anyone anything. I'm definitely not a financial advisor. I'm just sharing my story with everyone. Okay. And if you have any questions, just feel free to ask your questions. Let's see here. All right. So I started my career in the mortgage industry in the mid-90s. Refinances. I was doing a lot of refinances, FHA at that time, and I was refinancing at 9.5% interest rate. Now, you all know where we're at with interest rates right now. They're still like history. I mean, really just low interest rates. And we're not at the 2 and 3s where we were at, like during COVID, but still 5 and 6% are relatively good interest rates. Have purchased over 100 properties throughout my career, done a lot of rehabbing, flipping. I did keep some of those properties, managed those properties just pretty much throughout my career. And in 2001, deviated a bit from real estate, built a restaurant, 150 capacity restaurant from ground up, and pretty much had about 15 people working there as staff, which included managers, servers, and chefs. Last 10 years of my career, I have focused 100% residential and commercial real estate, and have invested myself in multifamily and other projects. And so just to kind of share, in 2015, I purchased my first multifamily property, which was 34 units, and this was in Grand Prairie, Texas. And I have since expanded into El Paso, Texas, part of 310 doors, Houston, 180 doors, and then in Cleveland, 187 doors. And currently working also on a hotel development project in California and a parking structure. So I was able to, take my first multifamily deal, manage it properly, and I'll explain a little bit more of kind of what we did, and was able to turn around, sell it for a really great price, and have been able to now diversify my investments. So really, I was kind of looking for a way to just make my money work for me. We have to work so hard to make money, right? And I was just thinking, okay, there's got to be another way to create this cash flow that we hear everyone talking about, and generational wealth. And here are some of the reasons, why I invested in multifamily property, and really hope that it inspires you guys to do the same. Number one, we were looking for cash flow, right? How can we, where do we put our money where we can actually just make money from that? And cash flow, very simple, is your rental income minus all of your expenses. Okay. Number two, we thought, well, what a great opportunity that this property, there's this vehicle that's going to produce cash flow, that's going to pay down your loan. Your tenants are really paying down your loan. So I think, for us, it was like, oh my gosh, this works perfect. And then number three, it was appreciation. Here, you're actually benefit. I mean, like, you're banking on the fact that this property is going to appreciate over the long run. All right. And number four, it was tax benefits. Okay, so there's various tax benefits, but for me at that time, it was depreciation, which really it allows you to expense a portion of the physical structure each year, and the 1031 exchange, which allows you to defer that capital gain taxes. And there's no limit. You can do this as many times as you want, as long as it makes financial sense. Okay, and again, you may or may not find a property. And so if it doesn't, we just kind of, hold on one second. Okay. So I apologize. I was reading a message here. But anyway, so 1031 exchange just really allows you to defer that capital gain tax. Okay. I don't know, has anyone on this call done or been involved in a 1031 exchange? No?
I haven't done. I just worked with a client who has a couple of times.
Okay.
He also did owner finance with a 1031 exchange. So he had $1 million. He sought out a building that was worth $2 million, and owner finance the other $1 million. And he paid it. I guess he paid it off in 3 years, because the building was worth $4 or $5 million in about 3 years, and he paid the owner back the $1 million. But he started with the 1031 exchange.
Perfect. Okay. So yeah, I mean, it's definitely a great, it's a great opportunity. I mean, we sold, and I was able to 1031 exchange into this potential, I mean, I don't even want to say it, but like millions of dollar deal. So I was able to take, a investment that I made good money on, turn around and reinvest it into another property, not pay any capital gains, and just pretty much wait until that appreciates, and until the project is complete, for us to really see the fruits of that investment. So 1031 exchange are definitely worth looking into. So a little bit about the property that I got myself, just the multifamily deal that I got myself involved. And really, it's a value add opportunity. Do you guys understand what value add opportunity is, or like just what value add means?
Yeah.
It's a property that basically you can, hi everybody, I'm Pat. It's a property that you can customize, that you can basically either make changes to or upgrade in order to bring that value to the current market that we're in. So like getting a fixer and then basically remodeling it, or maybe adding in, another room to it, or extending the home so that you can sell it for more money than what you bought it for.
Perfect. With multifamily, you want to add one more thing to that, which is, you're increasing the net operating income, right? Because you have multiple doors. So in addition to all the stuff that you said, it also increases its net operating income, which is how in multifamily, the value of the property improves. So we're good there. So multifamily, value add multifamily that I purchased needed a lot of work. And like I mentioned, I've had a lot of experience in rehabbing and flipping properties. And so when we saw the...
Annabelle,
Yes,
a question. So when you say in the multifamily,
yes.
when you talk the value add increasing the net operating income, is that a function of you're able to increase rent, or is that a function of something else? In other words, just by making those changes, what then gives you that space to where you're able to say, oh, I've been able to increase my net operating income?
Sure.
Is
Okay,
that-
perfect. No, excellent question. So in multifamily, and in this particular multifamily, it needed to be, it's like a fixer. For residential, I think we'll all understand it, it's a fixer upper, right? You fix the property, the condition of the property, you remodel, let's say the kitchen, the bathrooms, new paint, new flooring. And now that, maybe you picked up that property for 200. Now that you've done all of those improvements, this property is now worth, let's say 400. Okay. In multifamily, we're going to improve the condition of the property, but we're not selling it. What we're doing is that we're improving or increasing its net operating income, which is its rent. So previous to the repairs, this unit, let's say a 1-bedroom, 1-bath, was getting $600. Well, after your repairs, you can now increase this property to maybe instead of $600, you can go to $800 a month. That net operating income is $200 a month times 12 is $2,400. $2,400. So each unit that you repair will improve its net operating income by whatever that amount is that you're going to increase its rent. Does that make sense?
Yes, that's what I was thinking based on you're able to increase the rent. So I appreciate it. Thanks.
Yes. And so Patricia said, you know what, it's improving the condition of the home, right? So that way you can bring it up to whatever the market comps are in that area in this market. In multifamily, it is that, yes, but it's also increasing the net operating income because you have multiple doors that are giving you rent, and the value of the property is based on the rent that property produces, not just the repairs. Yes, the repairs have a lot to do with you being able to improve its net operating income. So pretty much I went in there, fixed up the property. And when I purchased this property, I actually just had spoken to the seller of the property and asked if he would be interested in carrying a note for me. And it worked out well because, you know what, we gave him a $350 down payment, and we had the remaining amount of the remaining balance of $500,000. We just made monthly payments to him. And that gave us time to really go out there and like fix the property, like remodel it, update it, and increase rents. Okay, someone's playing around, Jess. Jess?
Yeah, I had to get unmuted. I'm on it.
Okay, so right now, like so something to take into consideration as well is when the property is not a producing property, like it's not producing what it should be producing, the banks aren't going to lend you that easily either, right? The bank wants to make sure that we're going to be able to, that property can sustain itself. And so at that moment, I knew that this property was not going to be in a position for us to just go and get your traditional finance. And so I thought it would just be easiest if he can sell or carry for us. We do this and, oh my gosh, really? Okay. Who's
You're
doing
being
this?
bombed.
I know. Well, who the heck is doing this? This is crazy. I mean, really, they don't have better things to do than bomb a multifamily call. All right, whatever. I don't know.
As soon as I
Jess.
figure out who it is, I'll get them out. Don't worry.
I have no idea how to, I don't even know where to start. So anyway, let's just ignore stupidity. No reason to pay attention to it. So anyway, oh my gosh, that's ridiculous.
Annabelle, so I had a question on, you mentioned a seller carryback,
Sorry. Yes.
and I just put it in the chat, but I'll just go ahead and ask my question here
Yes.
while you're flipping through your slides.
Yes.
So when a seller decides to, or when they agree to carry back a portion of the sales price,
Uh-huh.
does a seller also review the buyer's financials to make sure that they can pay back on that loan that they're carrying? Or like, how does that work?
Yeah.
Because there's not a lender that's involved, right? For the seller carryback, it's basically the seller that's going to be the lender.
Correct. So I think that number one, it's you know, we have to sell ourselves every single day, right? Every day we have to sell ourselves to clients, to anybody. And I think that when, in my case, I approached the seller who was the agent on the deal. I pretty much sold him on the fact that I've been in business long enough. I know how to do this. You know, this was my first multifamily deal. So, and I was very upfront. I've done multiple houses and I've invested and I've been very involved in it. And, but this was my first multifamily deal. I wasn't afraid of it. We had the experience, we knew how to do it. And I gave him $350 down payment. That's that's a significant amount of money.
Right.
So I think, you know what, he figured, okay, well, if they fail, I make $350 and I keep the property. He still wins.
Mm-hmm.
Right? I think that it's got to make sense. You have to, I mean, I don't think he would have done it for $100,000, and again, I don't know, maybe he had a loan, maybe he had a $200,000 loan on the property, right? My $350 might have covered that. And he made $150,000 to kind of keep going. But again, I don't know the specifics. I don't know, maybe, maybe he owed 300, maybe just made 50, but then I was making payments on 500,000 to him. They were interest only. I don't remember what they were, but I was making monthly payments to him on the 500,000, which was probably more than what he was making on the property right now, because the property was not, he wasn't taking care of it. He didn't have the money to take care of it. There was a lot of deferred maintenance on the property.
Mm-hmm.
So I think it just really depends on the situation. And, I always say it's worth a try, right? You have to put it out there and you have to ask. And if the seller says no, then at least you asked, right? But you didn't walk away from an opportunity or a possible opportunity.
Right. And is there an amortization schedule that's put together for the payments and, starting and ending date? Mm-hmm.
Yeah. So escrow, they use attorneys out there in Texas and they put all the contract. I mean, the attorney put everything in writing, everything was in a contract. Everybody was aware of, just everything and where and how payments were to be made. And just, I mean, it was it was thorough and organized and, it was very clear.
Okay. Sounds good. Thank you.
My pleasure. Good question. So, let's see here. So I pretty much, remodeled the property, and by year 2, The property was appraised at $1.6 million, which was huge because by then I had recovered my costs, right? Every money invested into this property, I had already, I was able to cash out. And I ran a property that I pretty much had pulled out all my money. Positive because the units at $1 million loan, I mean, it was more than giving us a very good return on a monthly basis. So this is, this is a great model of being able to purchase a property that you can improve its net operating income, improve the value of it. And hopefully, from the improvements of this net operating income, you can put yourself in a position where you could refinance and cash out some of those, some of the money that you've put in and leverage and go and invest in another property, right? That's the whole purpose. I mean, you want to really you want to leverage. Jess, were you able to figure out how we can get rid of all those blue lines?
Stop sharing and start sharing again, and you should be good now.
Okay.
Because I got them all removed. There was a couple of them.
How did they get in?
No idea.
Thank you for removing them.
Yes, I mean, it was annoying. Okay. So let's see here. Where was I? Oh yeah. So by year 2, I was at $1 million, and zero of my money in the property. I had already pretty much gotten all my money back, and property value as of a few months ago was $2.8 million. So I did very well. I did sell this property, and I 1031 exchanged into another project here in California, and also have just pretty much diversified into multifamily, because that is something that I am 100%. I mean, I am a firm believer of it being a great investment. And so I have invested with other partners, syndications that I'm involved with, and just pretty much diversified my investments. So any questions so far? Because this is the building. So I had 24 doors here. These were all 1 bedrooms, 1 bath. And then these were 10 units where they were 2 bedrooms, 1.5 bath, almost like townhome style. Any questions? Let me stop sharing here for a second, because I just want to make sure that we're good. Okay. Awesome.
I do have a question. Can you hear me?
Yes, go ahead. I can hear you.
So of course, other than you saw probably deferred maintenance needs on the property,
100%.
or was it that you knew that that property had such needs? What was it that, and then maybe because I don't know if I heard you right, that the other person was also a realtor and that you probably knew that person. What was it that first attracted you to the property? And then of course, the space where you could make that offer with the contingency or seller hold financing.
So I don't know if so from previous, when I mentioned to you a little bit about my background, I've been involved in over 100 rehab purchase deals. When you have the experience, when you do a lot of rehab and like flips, you really learn, and I can't even explain it. I mean, it's like just something inside that for me, I'm able to tell. I mean, obviously I've studied the market. I have an idea of what the general price, I mean, when I bought this property, I did a lot of, I studied the market a lot, right? I needed to become familiar with the area that I was investing in, and I knew what the price per door was. when I was purchasing anywhere. Like you could tell me the Dallas area, you can, ask me Fort Worth or little different areas. You have an idea, you have a general idea of what the price per door is. And when I purchased mine, the price per door, and I honestly thought I was overpaying, was, I don't know, if someone has a calculator there, what's 34 doors divided by 850? That's what I paid per door. Someone figure that out? Yes, no?
So
Okay.
you're looking at about 25 per door.
Okay, so it was $25,000 a door. That's like, I mean, back then when I bought in 2015, one of my mentors had bought $10,000 a door. So I thought I was overpaying. But then again, I went in and I went ahead because I knew that the rents were completely, they were under market. And I knew why. As I toured the property, the condition of the units was just, it was terrible. I mean, terrible, roach infested, just really, really bad. So I knew just from my background, okay, if we come in here and we just like remodel this unit, again, this is a studio, I mean, a 1-bedroom, I'm like a kitchen, I put in, new kitchen, like new kitchen cabinets, new flooring, paint, a new bathroom, whatever. I'm not going to spend more than $5,000. I can turn around and I can increase this by $150 a month or $200 a month. It was a great deal, right? So again, you have to study the market. You have to become familiar with the price per door in the area that you're purchasing. And then you have to have a basic understanding of, okay, if I'm going to go into this property and remodel the units, what am I going to be able to make? What's my return going to be? How much is it going to take for me to invest per unit? And what is my return going to be per unit? So for me, it was very easy because I knew I may not have had the exact like numbers, but I knew in my mind that, and just from experience and studying the market, that if we come in, rehab these units, we can definitely increase rents by $200 because he was way below market, and it was because of the condition of the units.
What demographics did you look at in order to study the market? Specific.
I don't know how to answer that properly. I don't know. I don't know, Jeff. Maybe you have a better way of answering that. I don't know. I don't know.
Because I mean, from the real estate perspective, so comps are not necessarily good for multifamily in general because of the, the different rents and stuff for the market. So how did you knew that it was a good price per door? Probably that's easier.
Well, no, I did study. I did compare other apartment complexes near this one that I purchased. And I was looking, right? I'm looking at, you're looking at everything. Are you looking at, you're looking at price per door, you're looking at what are the current rents, right? And what condition are they at? I mean, I toured a lot of properties and I went in there and looked at the units. I wanted to see, how well done were these units and what they were making. And then you use that as reference, right? Like I can't, like my property, it's a Class C property. There's only so much that you can invest, or there's only so much you want to do in it for it to be profitable, right? I couldn't go in there and put, I really couldn't go in there and put like stainless steel appliances and granite countertop and like high-end wood cabinets and like maybe, stone or marble on the floor. I couldn't do that because I'd be like over improving a unit and I would not be able to get, very high rent. I knew what my max of rent was going to be for that area. And I knew the room I had in improving the unit. And that comes from just my experience of flipping homes. I was able to really just use that as as my way to analyze this deal for myself.
Okay.
I mean, maybe it sounds crazy, but I just think that, the experiences that just kind of what we go through in life, we will eventually use, and it benefits us. And I think that all those flips that I was involved with for many years just allowed this process when I invested in multifamily to just be easier.
Mm-hmm. Okay, thanks.
My pleasure. Great question. So let me introduce, I have Jeff McKee. He is from McKee Capital Group, who's joining us today. And he is an experienced real estate investor and a high-tech professional. And I wanted to bring him on board so that he could share a little bit more about multifamily. He's a general partner of over 3,500 apartments, pretty much representing $300 million in assets, 300 million plus. So there's more money there in assets under management, and a limited partner on 700 plus apartments. And he's invested in Texas, Louisiana, Arkansas, Georgia, Alabama, Florida, North Carolina. And he is the founder and the managing partner of McKee Capital Group. So welcome, Jeff.
Thank you, Annabelle.
Excited to hear more about multifamily from you.
Yeah, sounds good. You want me to share my screen?
Yeah.
Okay, let me know when you can see it.
Well,
Looks good.
Okay, so thanks again, Annabelle. So I'll just
Wait,
go
hold
through.
on.
No,
Not the presentation. We can just see your screen, but not the presentation.
Yeah, exactly.
Do what?
We can see this. We can see the screen, but not the presentation.
Oh, interesting. Let's see here. We'll try. We will try to share this again. That's weird. I don't know. I'm going to try a different. See if this comes.
Yep.
Does that come through?
Yeah.
No, that's weird. We'll skip through some of this because I know we're kind of short on time, and maybe we'll get to some of the answers. We won't really go through the table of contents. We've already gone through, a little bit of my background. That's good enough. You don't really need to go through the detail of the investments. We kind of highlighted all the different states that we're in. We'll get into some of the criteria here in a minute. I think many people are familiar with the general partner and all those responsibilities. So this is more for.
I'm sorry. I just want to make sure. So everyone on this call is clear on what the role of a general partner and a limited partner is? Yes, no?
No.
Yes? Okay.
Yes.
Okay.
Yeah. So sometimes they're called deal sponsors, GPs, all that kind of stuff. I think many of like I was in single family 5 years ago, and we did the fix and flip, the duplex, buy and hold long term, and then we got involved with some multifamily, a couple different mastermind groups, and then we decided to scale faster, and we totally skipped over the small multifamily, the 5, the 10, the 15, and we went straight for the 100, the 200, the 500. But part of the reason why is because of this, if you start at the top, cash flow and capital gains, there's some great opportunities with doing syndications, private placement, apartment investing. It's a hedge against inflation. Again, this is, it's truer now than it was a few years ago when inflation was, 2%. And just, we're able to increase rents like Annabelle was talking about. And then that's the hedge, as well as using debt as a way to do financing and leverage, and you're paying back with cheaper dollars in the future. Obviously, there's some level of appreciation, although we don't count on it But the thing I like about, multifamily is its forced appreciation. Kind of like Annabelle was saying, you could put in 5,000 a unit, you can do some exterior renovations, and you could increase the net operating income of your asset. Whereas on some of the single families, you're basically dealing with comparables. It's a little bit harder to force appreciation in some of that. And then, with multifamily, the government is really wanting you to help provide shelter for other Americans because the government doesn't want to do all this government subsidized housing. So to the extent a private citizen is funding, even a limited partner gets tremendous depreciation losses and tax advantages, that's exactly what the government wants us to do so that they don't have to do it. Community and citizen improvement, where we'll go in and put pergolas, dog parks, barbecue pits. We're adding a pool to one of our assets in Corpus Christi, redoing a gym at one of the ones in Atlanta. So anyway, there's lots of things, and there's community events, that we do to sponsor that within that apartment community. It's not just an apartment complex. So that's a lot of what we do. And the economies of scale, again, going from instead of a 5 unit, a 500 unit. And to be able to do this at scale. So this is one of the key slides about, hey, why did you go from single family to multifamily? Why did you skip the small multifamily? And why didn't you do everything from A to Z for a 10 unit? It's like, well, if you add a zero, the same amount of work you put in a 10 unit transaction for a multifamily apartment is the same amount of time you put into 100 units. So why not go bigger? So that was a little bit on the strategy of going from single family to multifamily. And to the earlier question, what's some of the criteria? So Annabelle said, we're basically investing from Texas to Florida. I just added Arizona because we're actually under a letter of intent on 2 different properties in Scottsdale. So we're expanding to Arizona right now because one of our members of our mastermind lives in Scottsdale, and they've been, putting in offers since January. But in general, we're looking at the landlord-friendly states that are also business-friendly, which kind of knocks out California, knocks out Oregon, knocks out Washington, knocks out Illinois, New Jersey, New York. And so we're basically in the South and Southeast is the net of it. And we're looking for high net in migration of the population. Where are the jobs going? Where are the salaries going? Well, they're going, many cases, a lot of people, California goes to Arizona, to Texas, people from New York, New Jersey, they go to Florida. So anyway, that's why we're in those states. And then we are looking at tier 1, 2, and 3 cities. Maybe we're starting to look more at tier 1 and 2. Let's say Dallas, Fort Worth, Houston, Texas, and Austin, Texas, as opposed to Waco, Texas, Lubbock, Texas, some other places that we bought. So anyway, we're looking at that. Then on the right-hand side, we are not doing ground up construction, and we're not doing the class A luxury shiny object. The yield is a bit low. It's safer for sure. I've invested in Cardone Capital, and he bought a couple really nice class A, and you get 5 to 6% on your money, and he doesn't really pass on depreciation to you as a limited partner. But we call this like workforce housing, class B and C, blue collar, maybe some white collar service workers built in the 70s to maybe 2010. That's where, and maybe, with the economy, we're looking at a little bit more of the class B, the 1980s, 1970s. And then, again, we're looking at the larger properties. And for every 100 units, you can basically, the property can afford one person on the inside, full-time, a leasing agent, and one person on the outside, repair and maintenance, let's call them. So you go to 200, you're looking at 2 and 2. You go to 400, you're looking at 4 and 4. And then you start getting some redundancy the bigger you go. The other reason we like to go bigger is you tend to attract and retain the largest and best property management companies in that MSA, in that city. If you go for a 50 unit, a 70 unit, you oftentimes can't get a great property manager. And that's one of the critical success factors to driving up your net operating income, increasing rents and revenue, including other income, and let's say holding your expenses. I mean, I would say decreasing, but that's probably not realistic, but holding, and you're trying to maintain that 50% ratio between revenue and expenses, and having a great property manager can help you do that. So that's another area of where do we invest and why? And that's some of the geography of some of that. And then, many of you know accredited versus non-accredited. All of our deals that we do, McKee Capital Group, Think Multifamily, we do the non-accredited 506B as in Bravo, up to 35 non-accredited sophisticated investors. So I basically have to have individual one-on-one calls with each investor to see if this kind of investing is really right for them. If you did a 506C as in Charlie, you could go accredited only and you could publicize that, you could advertise. We don't do that, but those are the two main kind of exemptions that, from the SEC that we deal with, and I think many of you are familiar with that.
And what's the minimum investment on that?
Yeah, and if you look at the bottom of this slide, the minimum is 50,000 for the smaller. If it's less than, let's call it a $30 million purchase price, and it's 75,000 is typically our maximum minimum, if you will, for the larger, greater than 30 million. When you're dealing with non-accredited, you just have to be careful of the 35. So that's why our minimums are reasonably high. If you're accredited, like I've seen deals that are like, oh, if you're accredited, it's 10K to get in our deal or 25. They don't have to worry about the number of investors because they can handle an unlimited number of accredited. But when you're dealing with the 506B, that's why our minimums typically start at 50. And then here are the returns on the top box there. Again, these are guidelines. These are not promised or anything. So, 14 to 18% IRR. So when we're talking about price per door, when we're talking about underwriting, cap rates, that's where we're looking at, what is the realistic return? The other target we look at is that fourth bullet. We look to double the investor's money of capital in the deal within a 6-year period. If we can do it, project it in 5, we'll do it. But that's another criteria. And honestly, if we get to a situation where it's a 9% internal rate of return and it's 10 years to double the money, those are the deals we pass on. We just can't get the numbers to work. And unless we can get the price down, which you can get the price down a little bit in today's market because the interest rates are going up. But if we can't get the numbers to work, we'll pass. So for every 100 deals we underwrite, we end up bringing 1 to the finish line. So there's a lot of work that goes in by a lot of team members and a lot of cities to finally get a deal that's a purchase and sale agreement with the seller at reasonable terms, working with the lender, and then we go raise the money and close that deal. But so let's call it 1 out of 100 that we actually are able to bring to investors. There's a lot of work that goes on deals that we just pass on. We do have an 8% preferred return. Again, it's not guaranteed and it's cumulative, which means the day that we close that property, that 8% starts accumulating. Now, we might not pay it for the first 12 months because we're trying to stabilize the property, put in all that CapEx, and then we'll catch up by the end of year 2. So if we don't pay any of the 8% in year 1, our plan is to roll that to year 2. You got the year 2 8% and then add 8% rollover. So our goal is by the end of year 2 to pay 16%. So if someone put in 100K, our plan is to distribute 16,000 by the end of year 2. About half of our deals have a cash out refi. We go from a bridge debt to an agency debt in about year 3, and we'll return 40 to 60% of the capital. And that helps increase the internal rate of return because you're providing capital back to that investor earlier in the hold period. And that's how we get to those 18, 20% IRRs. About half of the deals don't have that. And that's where the IRR might be 16 or 17%. And that's where we start with agency day 1, like Fannie Mae or Freddie Mac. And it's a fixed rate loan and there's no refi during that hold period of the 5 or 6 years. And then 10% cash on cash. And then, that's basically the quick summary of all the slides. And then, my information's there. You can go to McKee Capital Group and you can schedule time. And then there's my email and my phone number. But I can go back to any of the slides, Annabelle, and start fielding questions. And then just so you know, I do have a hard stop at the top of the hour.
Oh yeah, so do I. No worries. So you said you guys are purchasing 100, 200, 300 doors.
Right.
What are the, like when you go out and I know you said you look at 100 properties and you pick one, what are you looking for? Like, what are those key points that you are looking for in this multifamily asset to decide if you're going to move forward or not?
Yeah. You start with weeding out things. So you look at crime rate. So if there's been a murder on the site, we'll pass, and honestly, there are some. And so it's hard to get insurance. It's hard to do a lot of things. Lender won't loan money to you. So, you're looking for things to weed out right off the top. Then we're looking for this loss to lease, which is the difference between the market rents for that asset in that local area and where that asset is. If they're already at market rents, it's probably not much meat left on the bone. We found an off-market deal, Jacksonville, Florida, 6 months ago, and the owner, it's his only multifamily asset. It's like 106 units. And he had never increased rents the whole time he owned it since 2019. And so on average, they're about $400 per month below market rents. Those are the kind of deals you look for kind of right off the top. And then you're looking at, does it have aluminum? What's the age of the asset? Does it have chiller boilers? Is it a garden style 2-story, or is it some mid-rise, or you're starting to look at some of that other criteria. And then you look at typically when they're an on market, you have a great offering memorandum from the broker, and they have really good statistics about what's going on in that MSA, the net in migration, salaries, jobs, who's hiring, all that stuff. So you're looking at the numbers of the area to make sure that employment is going up, salaries are going up. Another factor that we look at is what's the single family home average price going for near this apartment community. So for example, like some of the ones in Arizona, the single family homes are going for $800K and the price per door of this class C is $200K. It sounds expensive, but relatively speaking, those people can't afford to go to a single family home in that whole area. And so you're looking at, and vice versa, if you go into an area, it's easy to build single family and the average single family home is 90,000 and the price per door is 120. Well, then it's like, well, what's to stop the person from saving up a little bit of money and going to a single family home? So you're looking for some of those economics and barriers to entry, and there's 17 different tabs on the spreadsheet that we look at, but I mean those are just some key ones to get the ball rolling. We do a quick and dirty analyzer on some of those statistics to see if we can even get in the ballpark.
Fantastic. What do you recommend, or how does someone that's never invested or been part of a syndication, like what do you recommend that they should do in order to get involved or to learn what do they ask, right? Because they don't know who you are.
Yeah.
How do they get to know you? How do they feel comfortable? What should they ask for?
Yeah. I mean, like sites like mine, my McKee Capital Group, I've got an ebook that I wrote about multifamily, the questions to ask a deal sponsor, right? And so I think it's getting educated, whether it's doing research like that, doing podcasts, you can buy different books. Joe Fairless has a good book. And then there's the GP side, the general partner, if you want to be active, or there's the limited partner, you want to vet the sponsor and the deal. And then there's a whole series of questions that are out there that people can go down that list and say, oh, okay, well, here's the top things I'm going to ask about this particular deal, or about this person, about this group, and what are the most frequently asked. So I've got some of those, on my some resources like that on my website.
Can you put that on the chat? That way, maybe you guys can all go into that website and download that ebook. I think that's a great way to get yourself educated.
Yeah.
Should you want to explore the syndication route, which honestly, and I will be very honest, about 7-8 years ago, I would have never done a syndication. Never. I was a solo, solo investor. Like, let me do my own thing. I like to be in control of my own stuff, and that's it. And, just come to realize that you won't grow. You will not grow fast enough. And I like investing with other groups of people, and I think that they come across deals. They've analyzed it. I will also look at it. I'll analyze it. And if I feel comfortable and I see that there is an opportunity for that improve, like a value add opportunity, I'm in.
Yeah, for sure.
So any questions? This is a good opportunity to ask a professional. You guys all got it. Everybody's gonna know where to go.
I do have a question.
Great.
Can you hear me?
Yes, we can hear you.
Okay, thank you. So once you go through the period when you either do the return or do the payouts, say after year 6, do you, on most of your properties, do you either sell them out or do you continue to manage over the time?
Yeah, currently we sell ours 100%. There are other syndicators that basically provide the limited partners double their money and they get them out of the deal and then they own and manage and they don't sell. But all of ours, we just sell the whole thing.
Thank you.
Yep.
And I know of others that will refinance, try to cash out the investors, at least try to get 100% of their money, and they keep the property and it continues to cash flow and you still continue to collect monthly cash flow on it, or they make a decision to sell and you've already got your money back and then they sell. So it really depends. I know that part, it just really depends on the group.
Yeah, like I'm in a limited partner in one deal down in San Antonio, and the GP team decided to do a cash out refi. So we got 90% of our capital back after 2 years, and we're still in the deal at the same limited partner ownership percent because everybody got proportionally the same back. So we get cash flow every quarter, and then whenever the deal sells, we still get a huge chunk of money. It'll probably be another couple of years.
Fantastic. No, I think that's great. That's what I love about this, because now you can invest, you can get your money back, you leverage, you can go and invest somewhere else. You now have an asset here, and that's how you can grow this. It's, it's monopoly.
Exactly.
Right?
Exactly. Yeah. Like in one deal in Dallas as a limited partner, I put in like 60,000 from a solo 401k, like a self-directed IRA. And then 3 years later, they returned 160,000 when they sold it. And so I have, so then I invested that in like the 2 different deals, and so it just can keep snowballing.
Yes. And that's why, I'm on this call. And again, this is a call. I'm not a professional. I have done this. I'm sharing my story with you guys. I've lived it. I would never have done, syndication 7-8 years ago. I didn't know anything about it. So I was just talking just to talk. But you know what? The more I've learned, the more I connect to people and I see how they do it and what they do. And if you just move your money and you diversify it and you put it into different projects, yes, you will grow. So I appreciate it, Jeff.
Yeah.
Thank you so very much.
Thank you very much, Annabelle. Thanks everybody for joining.
Yes, thank you so much. And if you've got to go, Jeff, go for it. I will. Okay. Yes, all right. Thank you. And we'll be in contact.
All right, sounds good. Take care.
All righty, take care.
All right, bye-bye.
All righty, bye. So, again, I just reiterate, it is definitely multifamily is the way to do it. At least this is what I like, and this is what I know. And and again, I'm sharing it with you guys. I do this call every single Wednesday. I have different guest speakers come on and talk about just all different, everything about multifamily. So I urge you guys to just come back, join me, and, bring questions, do some investigating, go on to other multifamily sites, listen to what they're saying, and let's make some money. All right. So William Holmes, you said, thank you, Jeff. Can he return? What do you mean by that? Can he return? Can I bring him back?
Yes. Can you bring him back? He was rapid fire, and so digesting a lot of things. There were some questions I wanted to ask, but I just wanted to put it together. But I was wondering whether or not he can return after reading his ebook and then knowing how to be better prepared and understand.
Well, you know what? Absolutely. We'll reach out to him and have him come back as a guest speaker. I say definitely check out his ebook. I'm going to be doing that right now as well. And, maybe we could discuss it ourselves as well and just, go through it. I get this is just education. The more education, the more you expose yourself to it, the better you will understand it. So, yes. Let's continue to do this. I will see you guys next week. If you have any questions, you know how to connect with me. And again, we meet every Wednesday at 2 p.m. See you guys. Thank you so very much for joining me today.
Thank you. Great seeing you. Welcome back.
All righty. Thank you. Take care.
Thank you all.
All righty. Take care. Bye-bye.